Okay, so next we want to talk about Chapter 10. So here we're going to talk about long-lived assets, plant assets, and intangible assets. And so here we're mainly talking about how do you treat these assets upon their acquisition. It's very similar to how we treated inventory in that what you're doing is capitalizing the costs to get these assets to where they're supposed to be and to their uh, use. All right, so what are these assets? Well, property, plant, and equipment, as plant assets are often called, are land, buildings on the land, equipment, machinery, furniture, autos, and trucks. So these are things you use in your business that help you to um, do whatever it is you do. Obviously, the autos they're talking about here, if you are an auto dealership, the autos that you sell are not part of property, plant, and equipment. They're part of your inventory in that example. Also, we're going to talk about natural resources. So oil and gas deposits, timber tracts, and mineral deposits like coal would qualify as natural resources. And what you're doing is you're extracting those from the ground. And then another asset called intangible assets, we're going to look at. Such examples of these types of assets are patents, copyrights, trademarks, franchises, and something called goodwill. All right, so here's an example of, well, a note that's included in a company's financial statements. And what this does is it more in more detail explains what property, plant, and equipment is made of. I'm sure in the financial statements, it's probably just a one-line number that says property, plant, and equipment gross 244 million 788 less accumulated depreciation 143 million 782 for a net PP&E of 101,066. But this is, of course, full disclosure. That's what you're trying to do in the notes. So they've expanded to uh, give a full accounting of each category of property, plant, and equipment. Here's an example of how you would have the intangible assets reported in a financial statement. So here it breaks out trade names or trademarks, patents, and then other. And remember, for intangible assets, we don't depreciate those, but sometimes, usually, we do amortize them. So if they're subject to amortization, that's what it's called, amortization, accumulated amortization. But it's the same concept. All right, so again, the point here is what costs do we capitalize um, when it comes to acquiring capital assets? Again, it's all costs to get the capital asset to its current location, and many times um, it's to its intended use. So for equipment, that could be the purchase price, of course, less discounts, taxes, transportation, installation, testing, trial runs, and reconditioning. For land, it's all those closing costs, which includes attorney's fees, taxes paid, title insurance, recording fees, commissions, realtor commissions, things like that. Also, for land, any cost to clear the land, if say you've got an old building on it that you're not going to use, so if you have to remove stuff like that, you can capitalize the cost. Of course, if you have any scrap that you sell that comes out of removing fixtures from the land or buildings from the land, you would reduce that cost from the land's cost, or the proceeds that you receive from the land's cost. Now, land improvements are recorded separately, and remember, land is not depreciated. Now, the building on the land would be depreciated over its useful life, but not the land itself. Another thing that is capitalized is land improvements, such as pavement, fences, sprinkler systems, you name it. And those are capitalized separately and depreciated separately. Buildings, of course, you capitalize the cost of the building. Closing costs would be involved there too. You're going to include any cost involved in getting the building up to whatever its intended use is. If you've got a warehouse that you need to change into office space, you're going to have some workout improvements to that. So any of those costs involved to get it to its intended use would be capitalized and depreciated as well. And then natural resources, we base all our acquisition cost, exploration costs, development, as well as any restoration costs. Whoa. Intangible assets, patents. There you have an exclusive 20-year right to manufacture a product or use a process. There, if it's in all these, pretty much it's the same deal. Any internally generated patents, trademarks, copyrights, you don't get to capitalize those. You just expense most things, and but what you can capitalize, you depreciate, or amortize those over its useful life. So we'll talk more about that. Most of the capitalization happening here is when you purchase, such as when you purchase a patent from someone who has developed the patent. You get to capitalize the cost on your books and amortize the cost over its useful life. So we'll talk more about that here in the future. All right, so, and the point here, as far as this explanation, is that you can acquire capital assets several different ways. The most common is you purchase a capital asset Um, Certainly, if you self-construct, say, a building, which is again a capital asset, you're going to capitalize all the costs of uh, creating that building and depreciate over its useful life, just as you would if you purchased it from someone else who constructed the building. The building could be donated. We'll look at how we handle that here. Could be in a business combination where you acquire an asset in exchange for stock. Could be leased. It could be exchanged, such as where you exchange an old uh, machine for a newer one. So there's all different kinds of ways that you can acquire an asset. And each one has its own little distinguishing features. So the initial cost is the purchase price plus all expenditures necessary to bring the asset to its desired condition and location for use. Again, for cost of equipment includes the purchase price, sales tax, transportation costs, insurance costs, expenditures for installation and testing, uh, legal fees to establish title, if any, and any other costs that brings the assets to its condition uh, for use and location. All right, so we have here an example. Purchase an industrial lathe to be used, and of course, any purchase discounts you would reduce the cost. Here, the purchase price is $62,000 for this lathe. They paid a freight company $1,000 to transport the machine to its plant location, plus $300 in shipping insurance. In addition, the machine had to be installed and mounted on a special platform at a cost of $1,200. After installation, several trial runs were made to ensure proper operation. The cost of these trials, including wasted materials, was $600. And so all those costs get to be capitalized and then depreciated over the machine's estimated useful life. All right, so here's a concept check. The following expenditures relate to equipment purchased by Symington Corporation. So you got the purchase price, transportation costs, installation and special wiring, and then testing. So every one of those costs certainly looks like what it would take to get the machine to its proper location and to its intended use. So whatever that amount is, looks like something with 900 on the end, so it's got to be B. Cost of land, purchase price is included. All those closing costs, such as attorney's fees and real estate commissions and title insurance and title search, recording fees, any back taxes paid, or any obligations that have to be paid by the buyer. And then, of course, any expenditures such as clearing, filling, draining, and even removing old buildings. Now, you capitalize those costs, but remember, you don't depreciate land. And again, proceeds from the sale of salvaged materials after purchase reduce the cost of the land. All right, so here we have an example. Buyer's Structural Metal Company purchased a 6-acre tract of land and an existing building for $500,000. Company plans to remove the old building and construct a new office building on the site. In addition to the purchase price, the company made the following expenditures at closing of the purchase. So title insurance, commissions, and property taxes certainly are all things that would be expected, and you capitalize those. A little more information. The $6,000 property taxes included $4,000 of delinquent taxes paid by buyers on behalf of the seller, and $2,000 attributed to the portion of the current fiscal year after the purchase date. Aha. So only $4,000 of that, the delinquent taxes, are capitalized. The other $2,000 will be expensed in the year incurred. Shortly after closing, the company paid a contractor to tear down an old building and remove it from the site. An additional $5,000 was paid to grade the land. Okay, so that's another $10,000 that gets added, and of course the $5,000 paid to grade the land is added to the cost. So really the only thing that's not added is the $2,000 in property taxes for the current period. That gets expensed in the year incurred. Everything else gets capitalized. And again, land improvements, you capitalize those costs separately from the land and you depreciate over their useful life. Again, examples are parking lots, driveways, roads, fences, sprinkler systems. Cost of the building. Cost of acquiring a building usually includes purchase price, real estate commissions and legal fees, reconditioning costs, anything to get it to its proper use. Natural resources, timber tracts, mineral deposits, oil and gas deposits. Now here, the benefits are derived from their physical consumption, and so that's what we base our what we call depletion. When you're dealing with natural resources, the cost allocation method is called depletion. Now, if you purchase natural resources, the cost is going to be the purchase price, or the capitalized amount is going to be the purchase price and any other costs necessary to bring the asset to its desired condition and location for use. And if developed, it's all those acquisition, exploration, development, and restoration costs. Now there's something called an asset retirement obligation, and this has to deal with future costs, usually at the end of the asset's life. So when you dispose of it or retire, you're going to have these additional costs. Usually they're called reclamation costs or something similar to that. These are recognized as a liability and measured at fair value if the value can be reasonably estimated. So you put it on your books as a liability. Now, some companies recognize the AROs gradually over the life of the asset, such as I think the book indicates an example where you have like a waste area where they dump trash, and over time you move to new areas, and so you create a new asset retirement obligation when you move to a new area of the dump site. And so an example of an ARO would be when oil and gas exploration companies uh, are required to restore land to its original condition after extraction of the oil and gas is completed. Normally, these are uh, required by the state in which the exploration occurs. Okay, so the scope part of it is the fact that they do arise from legal obligations created by the state. As far as recognition is concerned, uh, again, they might arise at the inception of the asset's life or during its operating life. We saw an example of that with the oil and gas situation. Uh, as far as measurement, the company recognizes the fair value of an ARO in the period it's incurred. The amount of the liability increases the valuation of the related asset. It's usually the fair value estimated by calculating the present value of the estimated future cash outflows. So and of course, there's a good example of the present value calculations on page 523. Hopefully they go through that here. All right, so here we have this example. Jackson Mining Company paid $1 million for the right to explore for a coal deposit of 500 acres of land in Pennsylvania. Costs of exploring for the coal deposit totaled $800,000, and intangible development costs incurred in digging and erecting the mine shaft were $500,000. In addition, Jackson purchased new excavation equipment for the project at a cost of $600,000. After the coal is removed from the site, the equipment will be sold. Now, any assets acquired that are separate from the land in this case and can be disposed of after its use, you capitalize those separately. And so here the 600,000 of excavation equipment, because it can be sold separately after its use, those are capitalized just like any other property, plant, and equipment and depreciated over its useful life. And so the other 2.3 million is really what we're looking at. Jackson is required by its contract to restore the land to a condition suitable for recreational use. After it extracts the coal has provided the following three cash flow possibilities, A, B, and C, for the restoration cost to be paid in 3 years after extraction is completed. And so we've done the calculations. We figure that there's a 30% possibility that we'll pay $500,000 at the end to restore the land. 50% chance we'll pay $600,000 to restore the land, and 20% possibility that we'll pay $700,000 to restore the land. The other part of this is when we figure out the present value is we have to know the company's credit adjusted risk-free interest rate. And so here for this company, that credit adjusted risk-free interest rate is 8%. And so what you're going to do, this is essentially a weighted average situation where you're going to take the weighted average of each possibility and multiply the possible outcome, the percentage times the possible cash outflow. So 500,000 times 30%, 600,000 times 50%, and 700,000 times 20%. We take those sums, we add them up to $590,000, and we multiply that by the present value of $1 at n equals 3, that being the number of periods, 3 years, and at their risk-free interest rate of 8%. And so the discounted present value of 590,000 at 8% for 3 years is 0.79383, or $468,360. And so that's the amount you're going to list as a liability under restoration costs. And it becomes part of the capitalized cost of the coal deposit. And so on your books, it's going to look like this. You capitalize $2,768,360 as your coal mine. You pay $2,300,000 here in this example, and the difference is going to be your asset retirement liability. And so the question is, well, the cash outflow, we summed it up to 590,000, and you've only accounted for 468,360 here. And so the difference we're going to have to expense every year for the next 3 years is what's called an accretion expense. And so let's look at that. Oh, and by the way, there's the second part of this, capitalizing the excavation equipment. And so this accretion expense is determined by taking your 468,360 and multiplying each year, well, that's your initial year calculation, multiplying that times 8% to come up with 37,469. And so that will be a debit to something called accretion expense, and you credit your asset retirement obligation for 37,469. The next year, it's going to be 8% times your ending balance at year 1, 505,829. So that's 40,466. And so debit accretion expense 40,466, and you credit ARO for that same amount. And then you do it for 3 using the ending balance for year 2. Now, what happens if you pay more than what you've amortized or expensed as far as accretion expense? And so here in this example, they actually pay $625,000 to do restoration to the land. You're simply going to recognize that as a loss.